Hello, friends. Very good and divine greetings of this beautiful evening to all of you. Here, I, Kunal Nagpal, welcome you once again to this great economic session. Dear guys, in these evening hours, we are basically going to discuss very important economic insights, and these will benefit you immensely to basically enhance and embrace your knowledge set with the enlightenment of the economic news. So, firstly, we will start with the COVID news, that is the latest COVID updates. Actually, the next 40 days are going to be very crucial as India may see the surge in the COVID-19 cases in January. The official sources said today, that is on 28 December 2022, citing the pattern of the previous outbreaks. Previously, it has been noticed that a new wave of the COVID-19 hits India around 30 to 35 days after it hits East Asia. This is a general trend which is being followed, an official said. The health ministry sources, however, said the overall severity of the infection is actually quite less. Even if there is a wave, the deaths and hospitalization will be very low, they said. Amid a spike in the COVID-19 cases in some countries, including China and South Korea, the government has basically sounded an alert and asked the states and union territories to prepare for any eventuality. The Prime Minister Shri Narendra Modi ji and the Health Minister Shri Mansukh Mandavia ji have held meetings to assess the country's preparedness to deal with a fresh surge in the cases. The latest spike in cases is actually being driven by the Omicron subvariant BF.7. The official sources said the overall transmissibility of this BF.7 subvariant is actually very high, and an infected person can further infect 16 persons. Moreover, in Uttar Pradesh, the mock drill conducted in 400 hospitals to check the COVID preparedness. And Italy imposes mandatory COVID tests for the travelers arriving from China, and that's the case also for Japan as well. The COVID cases may rise in India in the month of January, so the next month is actually very crucial. So, dear guys, now we will begin with our basic economic news. Tatas brings all e-commerce ventures under the digital business gambit. The group last week increased the authorized share capital of Tata Digital by 1,000 crore rupees to 21,000 crore rupees and infused 750 crore rupees into the company as per the fillings of the registrar and the Companies Act provisions. In the fillings, the Tata Digital said the authorized capital was basically increased considering its business plans, repayment of debt, and the investments to be made from time to time. Next, the banks and non-banking financial corporations, that is NBFCs, must be ready for the market risks and tech threats as per the Reserve Bank of India. The banks and non-banking financial companies should basically tune their management strategies to face the challenges from the market risk, technology, consumer protection, and sustainability, which are set to become the pillars of the future financial sector regulations, RBI said. The Indian financial sector has weathered the COVID storm and has emerged stronger with the higher capital, better asset quality, and improved profitability, the Reserve Bank of India said in its report on the trends and progress of banking in India. I repeat, the Indian financial sector has weathered the COVID storm and has emerged stronger with higher capital, better asset quality, and improved profitability, the RBI said in its report on the trends and progress of banking in India. The banks and non-banking financial institutions will have to remain prepared to face new challenges and reap emerging opportunities in this dynamic environment. keeping their focus on appropriate business models, adoption of new technologies, sustainability, stability, consumer protection, and financial inclusion, the central bank said in the report. The Reserve Bank's forthcoming initiatives are basically expected to guide the progress of regulated entities in this direction, secure and preserve the financial stability, and hence enhance effective functioning of the markets. The Reserve Bank of India has been quick to respond to the COVID pandemic with it announcing a moratorium on the loan repayments, pumping in liquidity, and rolling out a loans restructuring program with stringent timelines. This has actually helped the financial system stable, but the global monetary tightening to fight inflation and emergence of the nimble fintechs is actually making the RBI to tune its regulatory framework to make finance affordable and at the same time ensure stability. It is actually imperative that banks ensure due diligence and a robust credit appraisal to limit the credit risk, the RBI said. The uncertainties basically characterizing fast-changing macroeconomic scenario amidst formidable global headwinds during 2022-23 can actually pose new challenges to the banking sector. If downside risks materialize, asset quality could be affected. So fast rising interest rates have strained the borrowers' repayment capabilities. Companies are facing the demand slowdown while rising the input costs are actually impacting the profit margins. While the first adoption of digital payments has helped propel the transactions to a high level, the influence of technology is also opening the doors for many unwanted practices that banks should guard against, it said. So with the success of UPI and mass adoption of digital banking services, various concerns such as unbridled engagement of the third parties, mis-selling, breach of data privacy, unfair business conduct, exorbitant interest rates, and unethical recovery practices have emerged, the RBI said. So banks need to develop appropriate business strategies, strengthen their governance framework, and implement cybersecurity measures to mitigate these concerns. So dear friends, this insightful article is actually quite relevant for the banking sector in today's scenario of the global headwinds. So this in-depth analysis has also provided the solution-oriented approach to the challenges being faced or is actually expected to face in the upcoming year. Now, we are basically going to discuss the interactive session ET had with Ms Rupal Bhansali, Chief Investment Officer and Portfolio Manager, Global Equities at Ariel Investments. She basically says that this is actually the time to sell the dip. Valuations of most companies in the United States and India are pricing in the best case scenarios, said Rupal Bhansali, Chief Investment Officer and Portfolio Manager, Global Equities at Ariel Investments. In an interview with Nishant Vasudevan, New York-based Bhansali spoke about various aspects of the market and investing. So here it goes. First question asked to this great pioneer is, as a contrarian value investor, what is your valuation of Indian equities? What is your evaluation of Indian equities? To which she answers, the short answer is, I am bearish in the near term. In the long term, India has a lot of secular opportunities. In the next 1 or 2 years, India will not be immune to the global recession. The challenge in India has always been that money is in tight supply. So its budget deficit has gone up to 6% from 3%. It's actually very hard to to sustain that kind of budget deficit and continue to have a current account deficit. So a slowdown is likely. The idea is actually not to be afraid of a recession. I'm arguing that defense will be your best offense. I repeat, defense will be your best offense. Next question raised to her is, could you basically elaborate on how the investors should play defensive? To which she answers, the way to compound money is actually not through the capital appreciation, but through dividend reinvestment. In fact, one of my calls is that we are headed for a lost decade, which means that the markets end up lower at the end of the decade compared to the start, which has happened twice before in the S&P 500. The third question asked to her is, do you see the dividend yield opportunities in India? To which she says, not much, because the market is so rich and the dividend yields are the inverse of the valuation of a company. The two most expensive markets in the world are actually United States and India. In both these countries, the setup is a very positive one when it comes to equities. A lot of that is already in the price. What equity investors need to understand is you always must be mindful of what is already priced in. The two markets that I like are Brazil and the United Kingdom, especially in the context of dividend yields. Next question raised to her is, for Indian investors, what are the alternatives to high dividend yield? To which she answers, in the Indian market, given that people are making almost about 8% at the short end of the curve, it's actually a very attractive alternative, because there are very few dividend yields that come close to that, and the same is actually true in the United States stock market. The short end of the curve is almost 4 to 4.25%, and now soon heading towards 5%. That's an extremely competitive and compelling alternative. They used to say TINA, that is Tina, there is no alternative. I would like to call it TIAN, that is, there is an alternative. The equity markets need to understand that they are facing competition. Now, the next question asked to her is, we witnessed a tug of war between the hawkish Fed and the dovish market in 2022. Who will have the upper hand in 2023? She said, the Fed will have an upper hand in 2023. They are determined because they lost the battle. Now, they are determined to win the war. This is not just a war on inflation, which is a misunderstanding the market seems to have. The Fed is actually very concerned about service inflation, not just goods inflation. Service inflation remains very elevated and has crept into wage inflation. The Fed is nowhere near done. If you look at history, the Fed is usually not done till the interest rates are positive real rates, which is to stay here. And I would like to say that the interest rate exceeds the rate of inflation. Even today, it is squarely in negative rate territory. Also, people are overly focused on just the risk-free rate going up and do not realize the risk premium too has gone up. Today, the Fed's mission is not to help the Wall Street, it is actually to help the Main Street. Wall Street just needs to hear that message. So, how should the investors be positioned in 2023? To which she says, I'm reminded of the Nasdaq correction of the tech bubble in 2000. If you go back and see between 2000 and 2002, the Nasdaq corrected roughly 78% in a 2-year span, but it took nearly 3 years for that to happen. During that period, there were 20% plus bear market rallies. So even when the trajectory is down, you can still have some very sharp reversals. People should use these rallies to reduce their exposure and not increase it. Valuations of most companies, especially in the United States and in India, are pricing in the best case scenarios. The market is being extremely complacent because history has taught them for the last 11 to 12 years to buy the dip. And this is the time to sell the dip because these are the bear market rallies. Next question put to her is, are you actually willing to buy FANG stocks after the sell-off? To which she says, no, they are still very overvalued. The misconception about FANGs is that they were technology companies. They were not. They were advertising companies. The market completely underestimated the arrival of TikTok. Demand for the advertising was good and robust, but supply has increased so much. So the issue I have with the Indian stock market or any stock market is when the narratives transcend numbers. It is always a setup for disappointment. The false narrative in the market is that I am always going to watch Netflix or use Facebook. Now, these companies don't have to disappear. They just have to disappoint. Still, you can actually use and lose a lot of money. It does not mean I will stop using my iPhone, but that does not mean I pay 30 times for the Apple stock. It is not about what you believe. It is actually what is already priced in. Now the final question raised to her is, what is the one company that you like in India? To which she says, in my opinion, it would be Bajaj Finance. The first thing I look for in any financial services company is whether they have good underwriting standards. Second, I like the companies in emerging markets which serve the mass market and at an affordable price point. So, from a growth rate and risk-adjusted profitability perspective, this company comes to my mind. There are basically short-term valuation concerns, but in the long run, I can see a business model that has survived the test of time. I want to be candid that I am not invested in it. There are better opportunities elsewhere. So again, this very interesting question answer round has provided us great insights with an in-depth analysis. Now, we are going to discuss the basic news regarding currency appreciation for our economy. That is, the rupee slides 20 paise to close at 82.85 rupees per dollar. I'm sorry, this is actually currency depreciation. The rupee declined 20 paise to close at 82.85 against the US dollar on Tuesday, pressured by month-end dollar demand from importers and foreign capital outflows. At the interbank foreign exchange market, the rupee opened lower at 82.71 against the greenback and witnessed an intraday high of 82.69 and a low of 82.87. It finally settled at 82.85, down 20 paise over its previous close of 82.65. The dollar index, which gauges the greenback's strength against a basket of 6 currencies, was trading 0.27% lower at 104.02. The global oil benchmark Brent crude futures rose 0.83% to 84.62 USD per barrel. The 30-share BSE Sensex ended 361.01 points or 0.60% higher at 60,927.43, while the broader NSE Nifty climbed 117.70 points or 0.65% to 18,132.30. The financial institutional investors were net sellers in the capital markets on Monday as they sold the shares worth 497.65 crore rupees according to the exchange data. The month-end dollar demand from oil importers and year-end rebalancing foreign fund outflows weighted on the Indian rupee in the Tuesday's trade as it surrendered Monday's gain. The surge in the crude and precious metal prices also weighed on the local unit, said Mr. Dilip Kumar, research analyst, HDFC Securities. The rupee has actually been stuck in the range of 82.40 to 82.90, lacking the directional move ahead of the year end. In the near term, the rupee is actually expected to trade between 82.40 to 82.90 against the US dollar. The bias for the local currency remains weak as long as it trades below 82.40, Mr. Palmer added. According to an official announcement on Monday, that is on 26 December 2022, China will scrap the quarantine for international travelers from January 8 next year as it reopens its international borders and comes out of international isolation after nearly 3 years. So this in-depth analysis about the currency depreciation of the Indian economy is again very, very insightful. Moreover, we are going to put forward the 6 ways Dr. Nirmala Sitharaman which can actually help Dr. Nirmala Sitharaman in helping the Indian household finances while framing the budget for the year 2023. The Finance Minister, Dr. Nirmala Sitharaman, is about to present the Union Budget on February 1. It remains to be seen if the Finance Minister bites the income tax bullet that she has been evading for several years. The pandemic is over, or so we thought. But it seems with the re-emergence of the virus in the neighboring China, another COVID wave here in India cannot be ruled out. And that's what we had just said, that there is actually an expectation that the surge in the COVID cases would arise in next 30 to 35 days. That is, the next 40 days are quite crucial because in the month of January, we can see the surge in the COVID cases. That's what has been predicted as of now. The return of COVID would definitely have complicated the matter for the Narendra Modi government, which is about to present the union budget on February 1. The COVID-induced job cuts and the income losses ruined the household budgets for the 2 straight years in 2020 and 2021. The high inflation since then is actually further straining the common man's budget. Higher fuel and service costs are further eroding their purchasing power. Now, needless to say, there is actually a case for some relief to the households. Here are some areas in which it is actually possible. Firstly, it can be the basic exemption limit. The Modi government did not bite this bullet for the last 7 years, despite a general election and a once-in-a-century pandemic. It was last revised in 2014-15. Needless to say, the increase in the limit will actually provide relief as well as reduce the burden of income tax return filings on the system. Second, income tax slabs. In India, the highest income tax rate is 30%, which applies to the income as low as 10 lakh rupees, that is the old regime, and 15 lakh rupees, that is the new regime. After including the cess and surcharge, it can reach 42.77% for the income exceeding 5 crore rupees. This is actually significantly higher than in other countries. For instance, the highest tax rate is 17% in Hong Kong, 22% in Singapore, and 30% in Malaysia. Many argue that the government should increase the threshold limit for the highest tax rate to nearly 20 lakh rupees, while the highest tax rate of about 42% can be reduced to about 35%. The third basic way out is the new tax regime. The Union Budget 2020 introduced the optional exemptions-free tax regime. With this new regime, the government tried to simplify the tax filing process by doing away with almost 70 types of deductions and exemptions, including deductions for the household rent allowance, that is HRA, leave travel allowance, housing loan interest, and the standard deduction, among others. Reportedly, a few have migrated to the new regime. Hence, the experts have been asking the government to revise the new regime in order to make it more attractive. Next aspect is financial savings. The popular Section 80C limit has also been revised for many years. Despite the non-saving items such as tuition fees and housing loan principal repayment, Section 80C provides a deduction of only 1.5 lakh rupees, with the savings rate at a 19-year low of 26.2% of the gross domestic product in the first half of 2022-23. There is actually a case for an increase in the limit of the Section 80C. Now, the next aspect is interest rebate on home loans. With the hardening of mortgage rates, the real estate industry is basically asking the government to hike the current interest rebate on home loans from 1.5 lakh rupees. The interest rates on home loans have gone up by around 2% in last 7 months, pushing the EMIs, that is equated monthly installments, through the roof and putting enormous pressure on household budgets. Furthermore, the rebate has not been revised in many years, despite the fact that average house prices have increased by a factor of multiple over the years. Next is standard deduction. The government reinstated the standard deduction, which incorporated the transportation allowance and medical reimbursement. The government initially gave a deduction of nearly 40,000 rupees under this in the financial year 2019, which was subsequently hiked to 50,000 rupees a year later. So considering the high fuel prices in the last 2 years and higher cost medicines, apart from increased expenses due to the working from home reason, the Finance Minister Dr Nirmala Sitharaman can also increase the standard deduction limit to give more relief to the common man. And the final aspect is deductions on health insurance. Under the Section 80D of the Income Tax Act, a rebate of 25,000 rupees is given to the taxpayers for purchasing the health insurance. However, the premiums have shot up with the introduction of the COVID GST on insurance. A cut in the tax along with an increase in the rebate under Section 80D can further increase the penetration of health insurance. So this insightful discussion on the 6 ways which Dr. Nirmala Sitharaman can help the household finances of India for the budget, while for the budget reframing process in 2023 is actually very, very helpful. So, dear guys, I really hope that our today's evening discussion would have been very, very insightful and very helpful for you all to increase your knowledge set with the recent economic updates. So, dear guys, I would like to conclude my session here itself, and I really wish you all take very good care of yourselves until we meet next. Thank you so much. Namaskar. Jai Hind.